Life is not about finding yourself, it's about creating yourself. So live the life you imagine. Hello everyone, this is me Vibek, Paudyal, your host. Welcome to my book summary studio. Before diving into today's episode, as a bonus for listening to my summary, you have access to the PDF version of this book summary. The link is in the description below. In this podcast, I am taking the most important notes as a summary within 5 to 10 minutes so that you are saving some bucks of money as well as your precious time too. Please make sure that you have subscribed to the podcast however you are listening to me, and do not forget to share it with your friends so that they will also take the benefit of it. Without delay, let's get it started. Today, I am bringing you a great book, a perfect guide including lessons for investors and managers, which is one of the New York Times best-selling books. This book is written by a successful investor in history, one of the richest men in the world, Warren Buffett. He is considered one of the most successful investors, making him the world's fourth wealthiest person. So you can guess how valuable his lessons and insights in investing are. If you are an interested guy in business or investing, you probably know him. If not, you will know him very soon. And if you are planning to invest in stocks in any market, I strongly recommend listening to this summary. Listen carefully until the end of this podcast or video, however you are listening to me. In this summary, I am taking the main keynotes in a simple form so that you can easily understand what he is trying to say. He has explained in a very depth in value investing. Warren Buffett always suggests for long-term investment. According to him, there is no such person who massively made money by daily trading or short-term investment. All successful people have invested for long-term, at least 10 years. First, let's take a look. You are new in the stock market, you know nothing about it, but you know it's profitable if you put money in good stocks and want to buy some stocks, right? So here are the questions which come into your mind. First, how does it work? The second, which business stock should I buy? Third question, when do I have to buy these stocks? Fourth, when I can sell it and make profits, right? These are the common questions that arise in every person's mind. Warren Buffett has explained all these questions clearly in this book. Before starting investing, here is his first principle, which you should never forget. Rule number 1, never lose money. And the rule number 2 is never forget the rule number 1. This principle is very famous in his investing world. It is sure that you will not lose money after listening to this podcast if you follow the rules as Buffett has suggested. Okay, so the number 1 lesson from him is don't buy a stock, buy a business. What do you understand by this statement? This is the first mistake everybody makes in the beginning. Do you know how? Let's take an example. You heard about Tesla, that its stock is going up since last week and you want to buy it, right? Because it's going up and will be up continuously. In this case, you buy a stock, not a business, which is wrong. Warren Buffett suggests that at first you must understand the business on which stock you are interested in. Know their financial background, management team, look at their 10 years goal, means where can be that company in next 10 years. Is their vision clear? Does that company have a strong base value? Make some research, and if you are confident that this business or company will grow as expected in the future, then you can buy their stock, which is buying the business, so that you are also the part of that business. Now let's start from questions. The first question was, how does stock work? A stock, also known as equity, is a security that represents the ownership of a fraction of a corporation. Units of stock are called shares. A single share of the stock represents fractional ownership of the corporation in proportion to the total number of shares which is made available for public through stock exchange, where you can buy and sell the stocks or shares. In general, we buy at low price and sell at a higher price and we can make profit. But how much profit you can make depends upon the investment strategy you make. This is how stocks works. Right? The question second is, which business stock should I buy? So there are so many businesses to buy stocks wherever you are in this world. Every country has their own stock exchange company, and that regulates the policy and measures the list of companies available for trade through specific financial measurement and indicators. And it is said that most of the companies which are public are successful on some level, so that they get that position. However, the question is, will all these companies really become successful in the future? There are so many companies which have gone down and bankruptcy at the end. Therefore, number one lesson from Buffett is very important, as I mentioned above just before. Here are 4 points that Buffett suggests to look at business before buying stocks. There are 4 qualities we have to check. The first one, business quality; the second, management quality; the third, financial quality; and the fourth one is valuation, means reasonable price. So how to analyze these measures? It is not as difficult as we think. It's easy. Let's get started. So how can we check their business quality? Do you know about the products or services of that business which you are going to invest in? How quality products or services do they provide? How is their operation system? Have you ever used their products or services? If yes, then how satisfied are you with their products or services? How is their competitive market? These are key questions which help to filter good business. Next, could you estimate their future profit or loss for the next 10 to 15 years? If you cannot, then look for another business. So it was the business quality, how to check it. The second one is the management quality. Even the business is making so much profit, but the management team is hiding something from their investors or customers that the company cannot go for long term and will crash soon. Therefore, Warren Buffett always checks the reports of the top management team and CEO of the company. How is their working style? How is their thinking process? Because the company's future is in their mindset, in their performance, right? So, does the CEO check their own products? Does the CEO blame others or accepts the mistakes and makes it correct? Warren Buffett suggests that if the CEO in the management company accepts their mistake publicly, then there is a high chance of finding the problem and solving it, and they will never repeat the same mistake. So that company grows in a symmetrical way and doesn't decline with the fake news crowded marketplaces. So Warren Buffett says this: you cannot make a good deal with a bad person. So this is how we can check the management quality. The next one is the financial quality. In this test, Warren Buffett suggests to look at these 4 measures. Number 1 is debt to equity ratio. Choose those companies which have very low debt to equity ratio, or even not having debt is the best. If the company is debt free, there are no chances of bankruptcy in the future, right? So the second point is high return on equity. This means how much profit is making on $1 for their shareholders in a percentage in each year. Buffett suggests to choose a company which is earning at least 20% profit a year. That's the good business. Third point is high profit on margin. The profit on margin should be high. If the profit on margin is less, then we can understand that the company is fighting for price with the competition in the market price. Means that the company is selling such products through which the company cannot go back and sell them with high margin. Fourth point is pay dividends. The company should pay the profit through dividends to their shareholders. If not sharing to its shareholders, the company's share price should be increased through its profit. so that the shareholders can get their profits. If the company is not paying dividend directly, or share price is also not increasing, that means the company is not properly using their profit, right? So this is how we can check their financial quality. Now the next one is the valuation, means reasonable price. Great business with great management with great financial quality can still be a bad investment. If you pay a higher price for such a business, you may lose, or there are low chances of getting a high return on profit. Therefore, buying at a reasonable price is very important in the stock market. This mistake is done by mostly new investors. They choose the good company, but they pay higher price for the stock. So the question is how to know that how much is the valuable price of the company. Warren Buffett always calculates the total intrinsic value of the whole business, which is estimated, and then compares the total intrinsic value with the total market value. If the market value is less than the intrinsic value, then he buys those stocks with confidence. If it is more expensive than the intrinsic value, he suggests to wait, because the market always goes ups and downs. You may be thinking, so how to calculate the intrinsic value of the company, right? First of all, every public company publishes their financial reports in every quarter and on a yearly basis, through which you can get the detailed financial data. With the help of that, we can calculate the intrinsic value of the company, and we do not need to be mathematician or degree holder for just this calculation. We just need to know about the plus, minus, multiply, and divide. Let's take a real example of Warren Buffett. So in the year 1973, Buffett was interested in the Washington Post, and he calculated the value in this way. The owner's earning for that year was $10.4 million. Long-term US bond rate at that time was 6.8%. So the total business value is $10.4 million divided by 0.068, and which becomes $152 million. And total market value with buying price was $80 million. So let's look at here deeply. So the total business value is $152 million, and the total market value of the same business is $80 million. So you see here the difference. So $152 million minus $80 million, that becomes $72 million, which is the safety margin. Therefore, Buffett got 45% of margin safety, means you can save a lot of money. But he was expected to have around $400 million of market value at that time. And another point is that there was no other way of information except printed newspaper at that time, and he was sure that business can go further for 20 years without deflation. Therefore, these four measurements, the business quality, management quality, financial quality, and valuation or reasonable price, gives you the clear picture of the right company to buy a stock. So now you can buy a stock selecting the right company for your investment portfolio. There is another question, which is, when should I sell that stock? The answer is number one, sell the stock when the price of stock goes maximum higher than expected, which could be historically higher, mean only after 10 years, not before than that. Second, the company shows bad signs which could affect the whole future of the company, and you are sure that company is no longer going to be profit. While saying this, do not watch for short-term rise and fall without a specific reason. Short-term rise and fall generally happens in the market, which does not affect the real value of stocks. If you watch out this history, the market crashes in between 10 to 15 years. Even these crashes also don't affect the good companies for the long term. The right time to sell the stock is at the point when there is a clear picture of the company is not doing well. I mean, the service or products are no more going to capture the market like before. Means the company is generating low profit than ever in previous year or quarters. This is how you can select a good company and invest in that business and make money. Now you can find the good companies to invest for your future portfolio, and I hope you will start investing soon, right? And here are some principles of Warren Buffett which are very important laws to follow if you want to be a great investor. So let's begin. The first one is ignore the market, be a business analyst. You don't need to know how the world economy is going on. You just have to give focus only on that company in which you have invested. Mostly you can get the right opportunity to invest when the market crashes. The second one, choose the best. No need to diversify. You don't need to have 10 to 15 companies for diversification. Choose the best ones. Having 3 to 5 best companies is enough for diversification for your investment portfolio. Buffett believes that risk comes from not knowing what you are doing. The third one, bet big when it's the right time. Means when you are getting the right company with a cheap price, just that one company is enough to make you rich. Invest as much as you can with great confidence. The fourth one, when you buy a good company, hold it forever. If you look at the successful investors, they hold the business for a long period of time. They do not often buy and sell their stocks. They stick with it because they are sure that they are getting more and more profit through the power of compounding. The fifth one is price is what you pay, value is what you get. Means price is for value the product or service provides, it must resemble. The number 6, if you are not thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. Investing is not trading and has a vastly different goal like trading. When done well, it's about taking measured risk for discrete period of time at sufficient volume as to generate profit, but investing is about minimizing risk to generate wealth over the long term, not generating short-term profits. Therefore, Buffett always suggests to be an investor, not a trader, and me too. Even if you can be both a trader and investor, it's your choice. So, this is how I summarize this book. I hope that you learned a lot about investing and creating the best investing portfolio. Thank you for listening to this episode. I hope that you get the whole summary of this book and enjoy it. Don't forget to leave feedback and comments so that we can bring you the best version of ourselves. I'm leaving you now as I always do. See you in the next episode. Make every single day better, make somebody's day happier. Bye-bye.